All right, let's talk about something that can feel, well, a little complicated. NRI income tax in India. If you're earning money from India while living abroad, you know what I'm talking about. But what if we could clear it all up in just a few minutes? That's exactly what we're going to do. We'll give you a super clear guide to the rules, what you owe, and just as important, how you can save. Let's dive in. It's a common situation, right? Maybe you have a property back home generating rent, or you're seeing gains from investments. Whatever it is, those financial ties come with tax responsibilities. Our goal here is simple, to slice through all the confusing legal talk and give you a straight-up guide so you can handle it all like a pro. So here's our game plan. First, we're going to nail down what actually makes you an NRI in the first place. Then, we'll get into the nitty-gritty of what income is taxable. After that, we'll look at how the government collects the tax and, this is the good part, how you can find some relief. We'll wrap it all up with a simple checklist to keep you on the right track.
Okay, first things first. Your entire tax situation, everything we're about to talk about, really hinges on one single thing: your residential status. So let's get crystal clear on what it means to be a non-resident Indian in the eyes of the tax authorities.
You know, it really just boils down to a day count. The magic number to remember is 182. If you are physically in India for less than 182 days during a financial year, you're pretty much considered an NRI. There is that second condition, which is a bit more complex, but honestly, for most people, that 182-day rule is the main one to keep in your head.
So why does the status matter so much? Because it creates this massive difference in what you owe. See, a resident Indian pays tax on their global income, everything they earn anywhere in the world. But as an NRI, your tax liability is strictly limited. You only pay tax on income that comes from India. This is the single most important concept, and it changes everything.
So we've got the main rule down: Indian income only. But that leads to the next big question, right? What exactly counts as Indian income? Let's break it down. The law itself, in Section 5.2, gives us our guiding light. Any income that is received in India or that accrues or arises in India is taxable. And that also includes income that's deemed to arise in India, which is a fancy way of saying even if someone pays you abroad for work you did in India, it still counts. Now, looking at this list, you can see some obvious ones: salary, rent, capital gains from Indian assets, all taxable. But look closely at the bank interest. This is huge. Interest from an NRO account gets taxed, but interest from an NRE or FCNR account? Totally tax exempt. That right there is a real game changer for how you manage your money.
So if you're living on the other side of the world, how does the Indian government actually collect this tax from you? They've got a really efficient tool for this. It's called Tax Deducted at Source, or TDS, and it's all governed by a rule called Section 195.
And we're not talking about a small percentage here. A very common TDS rate is 30% plus any extra charges. So imagine that rental income we just talked about. This means nearly a third of it could be taken out for taxes before you even see a single rupee. It's a big chunk, taken right from the get-go.
And here is the absolute key to understanding Section 195. It puts the legal responsibility for deducting that tax on the person who is paying you. That's right, your tenant, the company you did work for, they are the ones legally required to deduct the tax and give it to the government. At this point, the burden isn't on you, the NRI, it's on them.
So this is what it looks like in practice. The person or company paying you in India does the math, they deduct the tax, and then they have to file some specific forms to report it. After that, they deposit the tax with the government, and you, the NRI, get the rest.
Okay, we've talked a lot about the obligations. Now for the really good part. How can you legally lower your tax bill? Well, the most powerful tool you have is something called a Double Tax Avoidance Agreement, or DTAA.
Think of a DTAA as a financial peace treaty between India and the country where you live. Its whole purpose is to make sure you don't get taxed twice on the exact same income, once in India and then again back in your home country. This can save you a serious amount of money.
And claiming these benefits is actually pretty straightforward. First, you need to get a tax residency certificate, or TRC, from the tax office in your home country. Then, you just file a simple self-declaration in India called Form 10F. You give those two documents to the person paying you in India, and that gives them a green light to use a lower tax rate.
And hey, it's not just about tax treaties. The Indian tax law itself has some special, lower rates built right in for NRIs. For example, some dividends can get taxed at a friendly 10% rate, and certain investment income might get a flat 20% rate, which is often way better than what a resident would pay.
So let's pull this all together with a super practical checklist. Think of these as the absolute must-do actions you need to take every year to make sure you're all set and compliant.
Here are 4 essential steps. 1. Make sure your PAN card, your Indian tax ID, is linked to your Aadhaar card if you have one. 2. Always collect your TDS certificates, which are called Form 16A, from everyone who deducted tax. 3. File the right income tax return. It's usually ITR 2 or 3 for NRIs. This is how you declare your income and claim any refunds you're owed. And finally, number 4, make sure the right declaration forms are filed whenever money is sent out of India.
So here's the bottom line. Understanding all these rules isn't just about paying what you owe, it's about paying the right amount and not a penny more. Between things like tax-exempt NRE interest and the major benefits of a DTAA, there are real opportunities to be smart and efficient. So the question I'll leave you with is this: are you taking full advantage of them?